Hello everybody and welcome to the Tortoise community. Today's video is on Netflix and the latest quarterly earnings report. Also, something that I want to discuss that we haven't talked about yet is regarding the recent proposal, the recent acquisition proposal of Warner Bros. And that has been an overhang on the stock. In fact, right after the announcement of that acquisition, Netflix shares dropped some 20%, if I'm not mistaken. So I just want to uncover everything that is going on, and hopefully I will be able to convey my message in an easy manner. Okay, so let's hop right into the charts. But before we do that, by the way, don't forget that this Saturday, the 31st of January, we have our second live event. So if you guys have been following me, you have been providing great support. This is your opportunity to raise any questions that you may have regarding any stocks, anything that you want to discuss. Make sure that you are on this call, because I would love to meet you guys once again after a very good experience the first time. Okay. So let's discuss what really matters, and that is Netflix. And you can see, where is this right here? You can see, full disclosure, I don't own any Netflix shares. That said, this is a company that has been on my watch list for a while. No, I didn't buy it around 2022. This is when you guys should have been buying the company if you were still bullish on it, of course, provided the thesis hadn't changed. This is when you should bring Netflix to my attention, not right here when the stock was trading at all-time highs. But anyway, a long story short, you can see that the company is down substantially from its down about 40%, right, from its all-time highs set in July 2025. And the main reason for this has to do with the recent, they want to acquire Warner Bros. All right. And so this, in the earnings report that were released, they really discuss that acquisition, the acquisition reasons at length, and how that would benefit the shareholders going forward. And so today, I just want to discuss everything that they discussed. Okay, and ultimately we will be able to determine whether Netflix is actually a buying opportunity at current levels, or if I still think that despite the drop, the stock is still expensive. Because remember, price is what you pay, value is what you get. Even if a stock drops 60%, the shares can still remain expensive relative to earnings and free cash flows. Okay, so this is what we are going to try to discuss here today. As always, I share the document with our community members. So if you haven't joined our WhatsApp and Skool communities, then do so, because it's entirely free. Full disclosure, the way I monetize my know-how, right, is through coaching, but I use these platforms for building a nice community and to communicate a lot of the things that I stumbled upon while doing my research, and also because I want to be as transparent as possible to build trust with you guys. Ultimately, if you succeed, I will succeed as well down the line. Okay, so let's go right here to the PDF that I shared with members this morning. And you can see, so let's talk about the most important things, okay? In fact, before I do that, I'm going to show you the report that they... this is the quarterly report, as you guys can see. And I want to talk about the most important things right here, right? So let's just read some of the most important passages. So, fellow shareholders, in 2025, we met or exceeded all of our financial objectives. For the year, we delivered 45.2 billion of revenue. That's up 16% year over year, or 17% on an FX neutral basis. This is for current, taking into account currency changes, right? Operating margin of 29.5%, which is plus 3 points. Ad revenue rose more than 2.5 times to over 1.5 billion. In quarter four, revenue increased 18% year over year, and we crossed the 322 million paid memberships milestone during the quarter. So you can see that the number of paid memberships continue to grow on a quarterly basis, which bodes very well for the company, right? This is good, very good. So operating income rose 30% year over year, and they say that engagement remains very healthy. In the second half of 2025, view hours increased 2% year over year. right? Driven by a 9% rise in viewings of branded originals. We will talk more about that as well. They are creating new content, which is creating stickiness with among current users, which will like that, right? So they spend more time watching Netflix, which is very good. In 2026, we are focused on improving our core business with an increasing variety and quality of series and films, enhancing our product experience, and further growing our ads business, right? Building our newer initiatives like Live, this is something that they have been greatly capitalizing on. And we saw that, for example, with live fight, with a live boxing match what's his name, between not Logan Paul, is his brother, and AJ, right, the former heavyweight champion, and so they are capitalizing on live events, which is very very good as well. It's very interesting because I think this is going to be a major tailwind for the company as well, given their reach going forward, with events including the World Baseball Classic in Japan, expanding into more content categories like video podcasts, and scaling our cloud-first game strategy. Working to close our acquisition of Warner Bros., which we will cover as well, sustaining health growth. We forecast 2026 revenue of 50.7 billion, between 50 and 51 billion. That's up 12% to 14% year over year, with ad revenue expected to roughly double and an operating margin of 31.5%. Okay, so the entertainment business remains vibrant and intensely competitive, and we are optimistic about our future. And this is the table that summarizes the main results. Look at this. So you can see that quarter four 2025 revenue increased by 17.6% versus 16% in the same quarter last year. Okay, so it's nice to see that revenues are growing. Look at the operating margin. It was 22.2% in quarter four 2024. Now it increased by 24, it decreased to 24.5%. And you can see that diluted earnings per share were 0.43, and now they are up to they are 0.56 as well. So we see things improving as well. And so this is very good. What you can see, guys, and in fact, this is the first thing that I want to show you. So yes, we have all this very healthy growth, and it's nice to see that margins, operating margins, remember, we want to see operating leverage over time. What the heck is operating leverage? In case you didn't watch some of my previous videos, operating leverage is when the business can spread out its costs right over a larger user base. In other words, the cost per revenue decreases as the business expands its operations and becomes, excuse me, that is my job, my dog. As the business expands operations and becomes more efficient. And so what we can see is, let me go here, bear with me 1 second. Let me show you the revenues of the company. Hold on. So let's do this Netflix. And let's use our revenues right here. So this is where we have revenues. Okay. Okay, cool. So what you can see, this goes back all the way to 2025. Let's put this to 2026, and you can see that revenue since 2026 have compounded by about 20.66%, which is very good. But look what happened since I zoom in on this graph. For example, since 2021, you can see that revenues have compounded by about 11%. So while revenues continue to grow healthy, those growth rates have been coming down as the business is becoming more mature. And sure enough, for example, if I show you the operating margin, let's show you the operating margin as well. Right? Look at that. So you can see that operating margin has been growing as well, which is exactly what you want to see in a more mature business. And what we will see is that part of the reasons the company has faced some selling pressure in its shares is because there is a repricing going on right now. Remember that for many, many years, Netflix has grown massively, right? Very attractively, but that growth has been decelerating and the margins have been improving with the business as the business becomes more mature and more efficient, which then begs the question. So if the growth is slowing down, if this is now becoming a mature companies, does it warrant a very high valuation attached to the stock? Okay, so this is what we will cover as well. All right. So what else do I want to cover here? This is a quarter four results in forecast, and you can see look at the forecast. Okay, so this is another thing. So look, they are projecting year-over-year growth to decline from the current 17.6% to the 15.3%. You see what I mean? So that growth is slowing down. Okay. And look, operating margin to expand from 24.5 to 32.1%, which is good. And they also expect diluted earnings per share to jump from 0.56% to 0.67, to 0.56 to 0.76. Okay, which is, this is all good, guys. Okay, this is very, I mean, this is attractive as well. But remember, the business was pricing in so much growth that okay, maybe that is not warranted. All right. So quarter four results and forecast. Quarter four revenue grew 18% year over year, driven primarily by membership growth, higher pricing, increased ad revenue. What else did I want to cover right here? Operating, percentage points. Look, operating income in quarter four was 3 billion, up 30% year over year, and operating margin expanded 2 percentage points year over year to 25%, both slightly ahead our forecast due primarily to the revenue upside. I love when they beat on their own forecasts. I like very good. To some extent, it may show some conservatism on their side, right? And I like that because, I mean, look, if you've been doing this for a while, I mean, you will see a ton of management teams that actually fall behind their own expectations. They fail to beat their expectations. This happened, for example, with the previous management of PayPal, and I really don't like that stuff. Okay, so diluted earnings per share amounted to this much, slightly above our forecast as well. Net income included 60 million of costs booked in interest expense related to our recent Warner Bros. Related bridge loan and associated breach reduction financing, which was not included in our guidance. So, what else? Look at that. They are forecasting this much, right? This much revenue growth. Okay. And okay, so let's discuss. I will satisfy all of them. All right, let's discuss now the main findings that I have right here based on my research, but my detailed research of the report, and also many of the things that I stumbled upon while doing my due diligence on Netflix. Okay, so you can see that Netflix is roughly 40% below its all-time highs. Okay, a few days ago they reported the quarter four earnings. While the headline numbers are strong, the market reaction shows that investors are increasingly focused on what comes next, not what just happened. Below is a structured long-term investor breakdown of the results, the guidance, and most importantly, the proposed acquisition of Warner Bros. Discovery. So remember, the markets, guys, the markets are forward-looking, and so many times we see companies reporting great earnings results, but because they provide guidance, they issue guidance that fails to meet analyst expectations. The shares come down, right? Even though the results were strong, because the market is forward looking. All right. Let's continue. Look at, this is the big picture, right? So Netflix delivered strong quarter four results, as we discussed, beating expectations on revenue and maintaining solid profitability. We also saw that subscriber growth remains resilient and the advertising tier continues to gain traction. However, guidance for 2026 was mixed, pointing to slower revenue growth, as we saw right here in the quarter one 2026 forecast of 15.3, well below the current 17.6% growth. So the proposed acquisition of Warner Bros. Discovery has become the dominant source of uncertainty for the stock, if you ask me. Despite strong execution in the core business, investors are clearly questioning capital allocation and deal risk. Quarter four performance, strong execution. All right, so revenue grew 17.6% year over year to 12.1 billion, beating consensus expectations of 11.97 billion. 90, all right. Operating margin profitability remains strong despite ongoing content investment. Content performance was a key driver of engagement during the quarter, supported by I mean, if you guys are subscribers to Netflix, as my sister certainly is, then you know, for example, that Stranger Things was another great success, right? The final season of Stranger Things. I mean, purely from a content standpoint, I think these guys are so ahead of competition because I've tried all the different live streaming giants. I tried the different streaming giants, right? From HBO to Apple to Netflix. I just think they are so ahead of competition. It's ridiculous. So yes, I understand the reason why, and of course, and you can see that in the numbers as well. But this to explain why the multiple is greater than that of the average company in the industry. It makes sense. The animated musical hit K-pop Demon Hunters, 2 NFL football games, and other popular releases. Against the backdrop where many legacy entertainment peers continue to struggle, Netflix has once again demonstrated operational strength and relevance. Okay, so guidance where the market got nervous. Looking ahead, we can see that revenue is projected to fall between 50 billion and 50.7 to 51.7 billion, right? So the growth is decelerating. Advertising revenue, this is another thing, is expected to double. Why? Because they want to remain competitive and they know that they have to spend. So this may very well be warranted, right? Operating margin target of 31.5%, which is still below the 32.6% consensus estimate. Based on this guidance, operating income is expected to reach about 16.1 billion, and that represents a 21% increase from 2025. In my opinion, this is good. Okay, while the bottom line remains strong, the deceleration in top line growth is a major concern for investors due to Netflix being a consistent high growth compounder. So this is the typical example of a company that used to be high growth but is now being repriced to reflect slowing fundamentals, guys. Okay, to reflect slowing growth rates. And if that is the case, and if and with the company, and if you happen to buy Netflix at highs, it may take you a long time to break even. Okay, because you had no margin of safety at this point. All right, let's continue. So, look, from a valuation snapshot, Netflix does not provide EPS guidance. It's unfortunate, but it's been like that for a while. But based on management's operating margins outlook, right, we can estimate 2026 earnings per share of roughly $3 because we know that they are guiding for operating margin. And so we can make a reasonable assumption about earnings per share in 2026, and that is about $3 per share. And sure enough, if I come here to stock unlock as well, and I'll show you something as well. If I go here to analysts, you can see the average earnings per share estimate. So if I click here for 2026, you can see that according to stock unlock, the average is about $3.30. Let's call it $3. Okay, and if you do that, and if you take the current stock over, if you take the current price of Netflix, which is 85, so if you divide 85 by 3, you get the forward PE of about 28 times. All right. Now let's have a look at the PE of the company over the last several years. And if I go here to metrics, valuation, you can see that the price to earnings going back to 2016, the medium is, look at the average, about 95, okay, with the medium around 76. So if they go on to meet these projections, right, so if they go on to achieve those earnings per share around $3, you can make the case that the company may be attractively priced relative to its history, okay. But another thing that I want to emphasize, now that we are on the topic of valuation, I will show you something that I found as well, right? And look at this. So because there, with Netflix, you have to, if we try to base it on a price to earnings ratio, right? Look what happens if we just zoom out on this. You can see that it's a bit all over the place, right? Going back to 2016, so you don't have that much consistency. And look what happens if I just do this, but for price to earnings, price to free cash flows. It's more of the same, right? And this makes sense because the company keeps reinvesting a lot into growth. So the price to free cash flow and the price to earnings may not be the most adequate figure to use here. But what I found after digging deeper was that price to earnings before interest and depreciation, so price to EBITDA, as it's called, right? So price relative to earnings before interest, interest, taxes, depreciation, and amortization. Look at that. You see what I mean? It's a lot more consistent over time, less noisy. That's what I want to say. Less noisy. You can see that the average since April 2015 is about 12.66 times, while the latest figure stands at 13.55 times. So you can make the case that based on this metric, Netflix is trading at about fair value. Okay, so just wanted to discuss that as well. Now let's discuss the big elephant in the room, which is the Warner Bros. Discovery the Warner Bros. Discovery deal, and the core risk that is right here. This is what I found. It took me a while to uncover this data. So if you are enjoying this video, please just smash the like button and leave a comment, okay? You can even say, what a shitty business, what a shitty video. But anyway, guys, just leave me feedback because I appreciate that. And I will for sure try my best to make future videos even better. All right, so the biggest overhang on the stock is Netflix proposed acquisition of Warner Bros. Discovery. The deal overview. Netflix is offering approximately $72 billion in cash for Warner Bros. And HBO assets. It would also assume $10.7 billion in net debt. Okay, so the total implied deal value is roughly $83 billion. This is significant, guys. Netflix recently amended the offer, as they discussed in this earnings release, to an all-cash deal, pausing share buybacks to conserve capital and provide greater certainty to Warner Bros. Discovery shareholders. In fact, I don't like the company doing buybacks when the stock price is already so high from a valuation standpoint, because that actually destroys shareholder value. But I mean, so I'm glad that they actually paused the buybacks. But so management argues the deal would significantly expand U.S. production capacity, add HBO and world-class content library, strengthen Netflix long-term moat. CEO Ted, excuse me, this is not CEO, so yeah, I made a mistake here. Ted Sarandos stated the acquisition will deliver the best outcome for stockholders, consumers, creators, and the broader entertainment community. Okay, so this is very, very important. So why the heck are analysts and investors skeptical? Because despite the strategic logic, key concerns remain. The deal size, the cash offer represents almost 6 times Netflix current net income, right? So remember, they are planning. Let's do the math right here. So $75 billion in cash for Warner Bros. If we go here to our stock analysis platform, if we go here to the trailing 12 months, what's going on here? Okay, it's taking. Now, all right, so let's go here to net income. You can see that net income is about 11 billion. Okay, well, actually, this is current. So this hasn't been, stock analysis hasn't updated yet to reflect the latest earnings report. So we have to use what we have in the document right here. But right here, you can see that I talk about this. Where is the recent earnings figure? I talk about that right here. Where is that? 12 billion. Where is this? This is operating income. Where is that? I thought I had shared this here in the document. Let me try, but I don't think I have. Let me see. Net income. No, it's actually only here. Okay, so in the last earnings report, so what I want to say is that unless you are paying for it, not just paying, for example, I'm paying for stock and lock, but it doesn't immediately update right after the company reports earnings, right? But some stock analysis platforms do update automatically, in real time, which is fantastic. For example, FinChat is one of them. Okay, but so let's use this net income, and let's do 11 billion. And what you can see is that if you do so let's go here, 6 times current net income, because they are using $72 billion in cash. And if we do, for example, 11 times 6, you can see that is over this over so it's over 66 billion. So you can say that the company is paying more than 6 times, right? The trailing 12 months, the trailing 12 months net income of around 11 billion. And that's exactly what I'm saying right here when I suggest that nearly 6 times Netflix current net income, because this net income is based on the company's quarterly report, right? Current earnings, right? So capital intensity, more than four years of Netflix annual content spend. That's what the current amount, that amount equates to. So this, of course, may very well add balance sheet risk, because Netflix will have to take on a meaningful amount of debt. Execution risk, right? This is the big problem for me is this. The big problem is that, as you will see, is that ever since the acquisition of Discovery, right, by Warner Bros. In 2022, you can see that the company has been underperforming massively, right? I mean, it can barely throw a profit. So if I show you Warner Bros. Discovery, they acquired Discovery in 2022, and if I show you revenues of course exploded because they acquired the company. But if I show you profitability, right, if I show you, for example, net income, you can see that the company is barely profitable since then. In fact, it's been largely unprofitable. All right. So, I mean, it adds fuel to the fire here. You have to question how how meaningful this acquisition will actually be for the company. For Netflix. But let me continue right here. So, okay, we discussed that. Adding to following execution risk in integrating a complex legacy media business. Following the earnings release, at least 10 analysts cut their price targets. Netflix shares continue to their slide. Adding to uncertainty, Paramount has submitted a compelling all-cash offer for Warner Bros. Discovery at $30 per share, potentially triggering a bidding war. So, is Warner Bros. Discovery worth the price? And what did I find? Look at this. This is the central question. Warner Brothers Discovery brings Warner Bros. Studios, right? So that include Harry Potter, Batman, Superman. This is all huge. Warner Bros. HBO, Game of Thrones, Succession, all these very all these blockbusters right here as well. The White Lotus, a valuable content library and theatrical distribution. What they Warner Bros. Discovery also includes legacy cable assets such as CNBC, CNN, TBS, and Turner Classic Movies. A structural decline in traditional TV. Financially, Warner Bros. Discovery has struggled. This is the main problem because you saw their 2024 revenue of about 39 billion is actually down from 41 billion the prior year. So if I go right here, this is what I found, right? Look at this. So revenues, if I show you the trailing 12-month figure, and if I go here to their revenues, you can see that revenues since 2000, since the merge, have actually come under pressure, right? So they are actually going down, and profitability has never been attractive. Okay, trailing 12 months revenue of 37 billion, right? Net loss of 11.3 billion last year due to asset write-downs. What does that mean? It means that they acquired the channel, right? So Discovery. But since then, because the price they paid didn't justify, so they didn't get a good value on that investment. And so what they have to do, they have to write down the assets. And what that does is it not only will reduce the value of those assets on the balance sheet, but that will actually decrease profitability on the income statement. And that is something that I don't like to see at all. No annual net profit since the Warner Discovery merger in 2022. This is very important. And then you have a forward PE ratio near 73 despite weak fundamentals. So the key risk for Netflix is that it may eventually need to write down acquired assets if these assets don't perform as the company expects, which means that the company is paying too high a price for them. They will have to write them down, and this again will impact the company's balance sheet and income statement as well. So what is my main takeaway, guys? My main takeaway is that Netflix core business remains strong, right? We see all of these things happening, but this acquisition just raises too many unanswered questions. It adds a lot of uncertainty. And this comes at a time when the growth rates are also decelerating. And so you have to factor in a bigger margin of safety going forward, in my opinion. Okay, and let me show you something else. You can see that I show you that revenues have grown at about 20% over the last since 2016. We were doing the EBITDA analysis. If I show you that, look at that EBITDA. You can see that EBITDA has been growing by about 22.74%. I think this number will come down sharply over time because the business is maturing. And over time, I think because we saw that since 2021, revenues have compounded by about 12%. I think the earnings before interest, taxes, depreciation, and amortization will start growing more in line with those numbers. And if that is the case, watch out, because that will compress valuation multiples as well. Okay, so look, this is just my understanding right here. I think the company is more attractively priced, but still that doesn't mean it's a buying opportunity at current prices. Last but not least, I want to show you something. Let's do a quick DCF analysis right here. You can see that Stock and Lock has a DCF calculator. Okay, and so you have this is default. So the metric to use in calculations, the default is to free cash flow in the case of Netflix. However, because we saw this is bumpy, given the investments as well that the company projects going forward, let's use our EBITDA, which is less noisy over time. We are projecting. I like to do 10-year. I like to project 10 years out, but we can do 5 years still, or let's do 10 years. Okay, never mind. Let's do 10 years. The annual EBIT growth over the last 10 years is 23.2%. 2%. I think this will come down. Let's assume, for example, 11%. Right, this everything else remains as is. The price to EBIT ratio, you can see that the average is about 12. I'm going to change this to about 10. Okay, let's do 10. And now the rate of return that I want is always 15% because I want to double my money every 4 to 5 years, and they don't pay any dividends. And so let's leave everything as is. And with these assumptions built in, you can see that today's stock price is 85, and the fair value will be around 41.96, which is about 50% lower. 50% lower. Now, look, is this actually realistic? You may. I mean, look, in my case, I always want 50% on my money. If I change this to 10, you can see that how big of a difference this is. So you can see that 65 will be the fair value for the company. But like I said, I want to make sure that I double my money every 4 to 5 years. And so this is what I would personally do. Now, look, if I keep here, for example, 15%, right, which is what I want, but now let's assume that I think the EBITDA will grow at about 15%, and that alone will already increase the fair value to $56 per share. Okay, so use these numbers the way that best suit you. I like to be conservative, and so for me, Netflix is definitely remains on my watch lists, and I will be very keen to understand how the story evolves over time, and whether or not this is going to whether or not they are really going ahead with the acquisition, and so I want to see the evolution of the company's balance sheet as well, right? Because they will be taking on a lot of that. It's going to be very interesting to follow up on this company ahead. So, guys, if you like this video, just smash the like button, and thank you so much for watching it. I hope you are deriving value from them.